Hello and welcome to our first lesson on Chapter 7. Before we get into the material, what I'd like to do is put a scenario into our heads for something to ponder. So consider that you just won a $10 million lottery and you have two choices for the payout. You could either take $2 million at the end of every year for the next 5 years or $8.5 million today. Which option would you take? Now in Canada, as an aside, our lotteries don't work this way. Our lotteries are, you get the whole thing all up front and tax-free. In the States, a lot of the lotteries work like the scenario that we're talking about here, especially the very large ones. So, and if I were in the room with you, I'd say, how many of you would take the $8.5 million today? And a bunch of hands would go up. And how many would take the $2 million at the end of 5 years? And some other hands would go up. And the reasons for that are, well, depend. Some people will say, well, why would I give up $1.5 million over the course of 5 years? I'll take the $2 million, and that way I'll get the full amount. So the correct answer in terms of what the best option is that it depends, and then we lead to, well, it depends on what, and that's the stuff of this module, starting with Chapter 7, 8, and 9. Now that I've given you something to ponder, let's get into Chapter 7, which focuses on the first part of time value of money considerations, and that is the single payment value. Chapter 7 has three major topics. First is now versus later concepts. Second is time value of money, or TVM basics. And third will be methods for solving time value of money problems. So let's begin with now versus later concepts, which explores the principles that help us understand why a dollar today is worth more than a dollar in the future. And by the end of this, we'll be able to explain some of the reasons why time affects the value of money and the importance of calculating what we call present and future values. So let's dive in. This first section on now versus later concepts has three main outcomes. First, to explain why time affects the value of money. Second, to understand the concepts of present and future value. And third, to recognize the role of lump sum cash flows in financial decision-making. And what we'll discover is that these foundations are pretty important, and they'll help us understand how to make better financial decisions, whether it's for personal investments, corporate finance, or other types of scenarios. So instead of the initial scenario with the lottery, let's simplify it a little bit. Imagine I offer you a choice, $1 today or $1 in 1 year. Now, which would you choose? Most of you would probably choose $1 today, and there's good reason for that. The primary reason of which is inflation. Inflation erodes the purchasing power of money over time. And if the prices increase due to inflation, the dollar you receive a year from now will buy less than the dollar that you would receive today. So how can we combat the evil effects of inflation? Well, as it turns out, there's a pretty crucial concept called the time value of money, or TVM. And it explains that money has the potential to earn interest, so that a dollar today can be invested, allowing it to grow over time, making it more valuable in the future. So for example, if inflation was 3% annually, but someone promised to return $1 to you after a year with 3% interest, you'd be made whole. So this means that you'd be indifferent to receiving the $1 today versus $1 a year from now, because even though inflation erodes the purchasing power of the dollar by 3%, the 3% interest that you would earn on the investment would offset the erosion. So now we'll focus on three key items. First, the time value of money. Second, the importance of calculating present and future value. And third, lump sum payments or receipts. The time value of money is one of the most important concepts in finance, and it's based on the idea that money can earn interest over time, which we've just seen. Therefore, $1 today is worth more than $1 in the future because today's money can be invested to grow. So, for example, if you invest $1 today at a certain interest rate, it will accumulate more value over time. The amount that you have in the future is called the future value, FV, while the current value of money, which factors in the potential future interest, is called the present value, or PV. And we'll be using these quite a bit in the next few chapters. In essence, the longer the money is invested and the higher the interest rate, the greater the accumulated interest income. So let's get into this PV and FV stuff a bit more. calculating present value and future value is critical in making financial decisions. And it's because these calculations are really at the heart of investment planning, saving strategies, even corporate finance concepts like capital budgeting. So, for instance, let's say that you are considering two investment options, one that promises a future payout and one that offers immediate returns, just kind of like we were dealing with at the very beginning with the lottery scenario. Well, it turns out that unless we calculate the present value of the future payouts, we won't be able to really compare those two opportunities. You remember when I said that your choice of whether to take the $8.5 million or the $2 million over 5 years really depends. And what it depends on is this present value stuff. So let's now talk about lump sum receipts or payments. A lump sum is a one-time cash inflow or outflow that occurs at a specific point in time, whether that's in the present or the future. So we can have a lump sum cash flow today, next week, a month from now, a year from now, 5, 10 years from now. The idea of these lump sums is that they're building blocks for a lot more complex financial transactions. So for example, all cash flow streams, whether they're from investments or annuities or loans, they can ultimately be broken down into a series of lump sum types of transactions. And understanding these is really important to enable us to tackle the more complex ones, such as capital investments or assessing the value of financial instruments. So, and what we'll also find is even though we can take every kind of time value problem and break it up into individual lump sums, what we'll see is that's really not efficient. And there are ways around that. But once we understand how the lump sum idea works, we can extend that to more complex and more regular streams of cash flows. All right, so let's start having some fun with this stuff and get into some of the time value of money or TVM basics. So what we're going to do is look at a single period scenario and then look at the impact of compounding over multiple periods of time, where we'll see that there are two contributors that affect the future value or the present value of money, and those are time and interest. So let's start small and work our way up. Our first single period example, let's assume that on November 1st, 2025, you deposit $1,000 into a bank account that pays 4% interest. So what that means is that 1 year in the future, at the close of business on October 31st, 2026, you'll have earned 4% interest, or 1,000 times 4% or times 0.04, that's $40. And the bank balance then is 1,000 plus that $40. We could also shortcut that calculation by taking the $1,000 and multiplying by 1.04. So that's the sum of 100% plus 4%. That's 1.04. I get a lot of questions on that from students sometimes. For a second example, let's say you put $300 into an account that pays 5% annual interest. After 1 year, it doesn't matter the date, you'll have earned $15. So 5% on 300 is 15. Adding that to the original $300 gives you a balance at the end of 1 year of $315. You could shortcut that by taking $300 times 1.05. That will give you your ending balance. Okay, so for a third example, we can use these time value calculations for not just deposits, but for anything that has a dollar value that is expected to change over time. So let's say, for example, we have a company whose 2025 earnings per share, EPS, you remember that from your accounting, is $2.50. And then the company experiences a 10% increase in its earnings in 2026. Well, because earnings ultimately end up as part of earnings per share, we can calculate the 2026 EPS to be the $2.50 plus 250 times 10%, which is the growth. That's $2.75. Or we can shortcut that by taking $2.50 times 1.10, so adding that 10% to 100%. That simply saves us from having to calculate the growth portion itself and then adding it. Of course, if we want to calculate only what the growth portion is, then we would have to take the 250 and multiply by the 10%. And for our last single period example, let's say that we have a retail store that plans on a 3% price increase in 2026 on an item that sells for $50 in 2025. So same idea as before, we could take the $50 and then add $50 times 3%, which is $51.50, or simply take 50 times 1.03. That'll get us to the same thing. All right, so now we'll add some more weights to the bar and look at the impact of compounding over more than one period. So a single lump sum present value will grow into a future lump sum through a process that we call compounding. And that's basically taking a sum of money that's invested over a span of time at a certain interest rate will compound in value and grow to a larger amount. And as I said before, this is the basis upon which investment analysts and financial planners will help you determine how much your investment will grow to, because when you put money in, it earns interest. Sometimes it earns dividends. Those are reinvested and they will grow. And then we'll also see here how time impacts compounding and how interest impacts compounding. So with respect to time, as long as the growth rate or the interest rate is positive, the passage of time will have the effect of growing that money. And the longer period of time that we have, the greater the growth, and therefore the greater the future value of the money, which is why investment financial planners recommend that you get started early. Get your kids putting $25 a month, a week, whatever it is, because the more time that their investments can earn that compound effect, the better off they're going to be. So we'll do a variation of our first single period example. We're on November 1st. You put $1,000 into a bank account at 4%. And now what's the balance after 2 years? So the long way to do it would be take $1,000 times 0.04 plus $40 times 0.04, which is $41.16. So that interest will grow to $40 in year one, and then $41.60 in year two for a total interest of $81.60. So our bank balance ends up being $1,081.60. And you see the subcalculation here. We have 1,040 times 1.04. That's $1,081.60, which is the same thing as 1,000 times 1.04 times 1.04. Or it's the same thing as 1,000 times 1.04 squares. So you see that exponent there allows us to apply compounding to any periods. If we want to know what that will grow to at the end of period 3, period 4, we would simply take 1,000 times 1.04 exponent 3, exponent 4, etc. But as you gather, doing things manually takes a bit of work. And as the complications and numbers get more complex and larger, then the opportunity for making errors also presents itself. So what we can do here is apply a formula. The formula for calculating the future value of any amount is simply the present value times 1 plus r to the exponent of n, or the number of periods. So FV is future value, PV is present value. R is the interest rate, also known as the growth rate, the discount rate. So there's a few different terms that we'll see for this. And n is the number of compounding periods. So if we go back to this $1,000 deposit at 4%, what's the balance after 3 years, 10 years, 50 years, or 1,000 years? Well, if we do it manually, using that formula, 3 years would be 1,000 times 1.04 exponent 3, which is 1124.86. 10 years, so exponent 10, 1,480.24. 50 years, exponent 50, 7106.68. And 1,000 years, well, that's a lot. So now I'm going to show you how to do the same thing using your financial calculator, because this is a tool that will be very handy for us. And the sooner we can start using it, the better off we'll be and the more comfortable you'll get. So if we want to do the same calculation for 3, 5, and 10 years, what we do is using that third row from the top, the gray row that has N, IY, PV, PMT, and FV. Now, before we do any calculations, the first thing I want you to do is make sure that you completely reset your calculator to get rid of anything in the memory, any values, or anything that might create some gremlins in our calculation. So if you press the yellow second button and then the plus minus button in the bottom row, just to the left of the equal sign, you'll see your display will say RST. Then just press enter, and that should reset everything, and then press the clear work button down at the bottom left corner. And now we're ready to enter some numbers. Going from left to right in your calculator, let's enter 3N, and then 4IY, 1,000 PV. You can put this in as a negative, or you can leave it as a positive. If you put it in as a negative, you want to make sure you use a little plus minus button. Then it'll kick out a positive number. And if you leave it as a positive, it'll actually produce a negative number. And that's simply because of the way the calculator interprets cash inflows and outflows. And we could talk more about that later. Put in 0 for PMT, and then press the compute button in the top left corner. and that FV, and you get 1,124.86. Now that this is already in our calculator, we can do 10 years super easy. There's no need to re-enter all the numbers. The only number that changes is N. So instead of 3N, just press 10, press N, and then compute FV. You'll get 1,480.24. And then let's do the same thing for 50 years. Override N with 50. Everything else stays the same. Compute the future value, 7106.68. Just as we saw before. And if you were curious about what 1,000 years looks like, put 1,000 in for N, compute future value, and you probably end up with INF or infinite. That means it's a pretty big number. Let's look at another example. You can get more comfortable with this stuff. So let's say Melvin's saving some money in an account at a local bank that earns 5% per year. So he begins with a deposit in his account of $100 and decides to save his money for exactly 1 year. Didn't make any further deposits into the account. So manually, the balance at the end of 1 year, $100 times 1.05 to the exponent 1, it's $105. And that means we can determine what the interest return is on that, right? So if the ending balance after 1 year is 105, the initial balance is $100, that's a $5 return. And if we use the formula, we can determine what the amounts will be at the ends of years 2, 3, 4, and 5 by simply taking 100 times 1.05 exponent 2, 3, 4, etc. So if you want, you can stop the video there and see if you can calculate a couple of those with your calculator manually, just to make sure that you can become comfortable with how to use the exponent function in the calculator. What you also might want to do there is use the time value of money functions to do the same thing. You can put in 2n, 5iy, 100 pv, 0 pmt, and compute the future value, and you'll get 110.25 for 2 years, and the same with those other numbers. Okay, so a fourth example. Same scenario, except now Melvin thinks he can leave his money in an account or investment for a total of 5 years, but he found investments that will provide annual returns of 6, 7, 10, and 12%. So what we can do here is do a bit of a comparison. We can say, well, at 5, 6, 7, 10, and 12%, what will those amounts look like at the end of 5 years? So manually, we know what 5% looks like, 127.63. So to determine the values at the end of 5 years, we can use the formula. At 5%, that's 100 times 1.05 exponent 5, or 5n, 5iy, 100 PV, 0 PMT, and compute the future value. If we want to look at the other interest rates now, you can manually recalculate using 6%, 7%, 10%, and 12%, but it'll be easier if we just change IY in the calculator from 5 to 6%. So put 6 IY, compute future value, you should get 133.82, 7 IY, 140.26, 10 IY, compute FV, 161.05, 12 IY, compute FV, 176.23, and we can see the differences there. So what this tells us then is that not only is compounding affected by time, in the sense that the more time you have, the larger the growth, the interest rate also has an impact. The higher the interest rate, the greater the growth, and therefore the larger the future value of the investment. All right, so for the third and last part of Chapter 7, we're going to extend what we just learned and look at methods for solving time value money problems. So we'll calculate future and present dollar amounts, which we've already done, but we'll reinforce that. And then I'll actually describe how we can calculate the growth rates or the discount rates with your calculator, basically R, and how we can calculate N. So this is that compounding example number 3. We've already done that, but look to see now what I've done is reflected this into a timeline to see what the balances at the end of each year would look like. So it starts at $100 at time 0. At the end of year 1 grows to 105, 110, 25, etc., all the way to 127.63. From this point forward, we'll be illustrating problems a lot of the times with timelines, because it really helps the students map out what the cash flows look like and actually make it a lot easier to solve the problems. So here's an example where we'll calculate the future value of a single lump sum, just kind of like we did before, but now with some timeline context. So you'll deposit $1,000 into an account earning 3%, this time for a period of 4 years, and you make no other deposits and withdraw no cash. How much will you have in your account? So we've got 4 years on our timeline, and I put my years in between so that we can differentiate between the beginning and the end of a year. If we put in $1,000, so a negative is we are investing. You're taking money from your bank account and putting it into an investment. Okay, so it's a cash outflow. And then as we move forward through time, we have 1, 2, 3, 4 hops. Those are those green arrows. I call them hops. And the question mark at the end is, what does that grow to? So using our calculator, we can simplify that. And these are the keystrokes that would be used with the B2 Plus and also with the Sharp or even with the HP calculator. So you'll clear your register, you'll enter $1,000 with the plus minus sign and press PV. Then for the interest rate, you can enter 3 and then just press IY. Don't enter 3%. The calculator knows that these are entered as percentages. Enter 4 for N and put in 0 for PMT. There is a reason why, even though there is no payment, I recommend putting in a value for every variable, because in case you forget to clear the TVM functions or reset your calculator, you'll have a phantom or a residual number in there, and that is something that we don't want. So let's go from left to right. So 4N, 3IY, 1,000 plus minus PV, 0 PMT, and then compute the future value, and 1125.51. Notice that by putting in the $1,000 with the plus minus sign as a negative, it spits out a positive result. So this means that you fork out $1,000 now, and then in 4 years, you'll receive 1112.51. If you entered that $1,000 without the plus minus sign, that's okay. It will give you a negative result, and all you do is consider these as absolute values now and say, okay, present value is 1,000, future value is 1125.51. Now let's calculate the present value of the lump sum. So you want to save some money for a trip in 5 years that you think will cost $8,000. How much do you need to invest today into an account that earns 5% annually? This is a realistic type of problem. If you want to save for a car and leverage the growth in your account, what do you need to put in now? So with our timeline, we've got 5 years. At the end of 5 years, we want to take out positive $8,000, which means we'll have to put something in. So this time we're going backwards 5 hops. What you'll do with your calculator is you can clear your calculator or not, but if we go from left to right, we'll enter 5N, then 5IY, 0 PMT, then 8,000 FV, and compute the PV, and you'll get 62, 68, 21. Notice that's a negative number, which is what we want. So this means that, okay, I need to invest, I need to put in 62, 68, and then I'll get back 8,000 in the future. All right, so let's say now we want to calculate the number of periods. So here's an example where we have $10,000 today, and we want to know how long it'll take for it to grow so that we can put a $14,000 down payment on a new car if we can put it into an account that earns 6% interest. So our timeline looks something like this. I have $10,000 going into an account, so that's an outflow. And then I don't know how many time periods there are, but I know that at the end, I want to pull out $14,000. So using our calculator, we would go from left to right. We don't know what N is now, but we know that the interest rate is 6, so 6 IY. I put in 10,000 plus minus PV, 0 PMT, and then 14,000 as a positive number in FV, and now I compute N, and that will give me 5.77 years. You can see now it's starting to become a lot easier to work with your calculator to do these. That's why we do them, a little bit of repetition, get them out of the way, and then become more comfortable with the tools that you have. Then last, we want to solve for the interest rate. So let's say that we have $10,000 today. I want to put down that $14,000 down payment on a car, but in a set number of years, so 4 years. So what rate of interest does that account have to earn to allow it to grow? Now my timeline looks like this. I have 4 years. I'm going to put $10,000 in. I'm going to pull $14,000 out at the end of year 4. We can see that that is 4 hops forward. Now, using your calculator, since we've already entered some of these variables from the last question we did, all you actually have to do is enter 4n and then compute IY. But let's walk this through from beginning to end. So 4n, 10,000 plus minus PV, 0 PMT, 14,000 FV, and now compute IY. This is 8.78%. And that's pretty much all of the lecture-related stuff for Chapter 7. So now I'll make available some in-class problems. I'll make a couple of shorter videos related to some of those so that you can view those at your leisure. Okay, so let's round out the chapter with some in-class problems just to solidify our knowledge. The first question that we're going to do is ICP 7.1. This is a simple lump sum present value calculation. And in this case, we're asked, what is the present value of $10,000 to be received in 10 years if the interest rate is 8%? Now, I highly recommend that you pause the video here and take an opportunity to try to solve the question yourself without seeing the solution, and then resume and see if you got your answer right. So in this case, the present value is the piece we're looking for. So the PV is a question mark. The $10,000 represents the future value. 10 years is N, and 8 is IY, the interest rate we're going to use. So entering in our calculator from left to right, we have 10N, 8 IY, 0 PMT, 10,000 FV, and we're going to compute the PV to be equal to $4,631.93. That's a nice easy one. Our second question is ICP 7.2. This is a lump sum future value calculation. So you just come into some money, $50,000. That's a hyphen, not a negative. And you want it invested for 12 years at 6% interest. How much will you have in 12 years? So that $50,000 represents the PV. The $12,000 is the N, number of periods. 6 is the IY. And entering in our calculator from left to right, 12N, 6 IY, 50,000 plus or minus PV. So we want to put that in as a negative, and it'll kick out a positive result. Or if you put it in as a positive number, the calculator will kick out a negative result, which is fine. You just interpret it accordingly. So 50,000 plus minus PV, 0 PMT, and compute FV, and you should end up with $100,609. And that's it for all the problems in Chapter 7.